Good evening to all of you, to all of the Zoom participants, but also to the WeChat live stream participants. On behalf of the Social Impact and Responsibility Club, I would like to welcome everybody to this year's Social Impact Week organized by our club. We have put together a series of events that we hope that you will find them exciting as we do. We are very honored today to launch our events with the opening remarks of Professor Dipak, who is the CEIBS European President. Immediately after his opening remarks, we will have our two first events, the panel discussion on ESG and green finance in China and Europe. And then we will have a distinguished talk about tackling the G of ESG. What can Chinese and Greek ancient philosophers teach us about leadership? Without further ado, I would like to welcome to the stage Professor Dipak, and thank you so much again. It is an immense honor to have you with us, Professor.
A very warm welcome on behalf of CEIBS. She said good evening, and I would welcome you all with good morning. It's about 5:30, past 5:30 a.m. in Chicago, and I was just engaged with someone. Sorry for we were starting a few minutes late, but it's a great honor for me to share with you a few remarks on this topic of sustainability and how today we as business school leaders should think of sustainability in creating a better business and a better world. When I look at any academic institution, I think that we have a three-dimensional purpose. The first is academic excellence. When MBA students start their program, they come to a business school to learn skills, tools, and concepts, and we as professors provide them with the best set of skills, tools, and concepts which have academic rigor or academic excellence. The second dimension is business relevance or industry relevance, because those tools, skills that we teach should be able to create better businesses, better industrial relations, and so on. And the third is social significance. And by social significance, I mean how you create a better community, a better society. So when I think of today's week, and we call it the MBA Social Impact Week, we need to think of all these three dimensions in an integrated way: academic excellence, business relevance, and social significance. I personally was very much driven by the social significance part. And when I was the dean of Northwestern University's Kellogg School of Management, we created a special initiative in our MBA program called SEEK, S-E-E-K, called Social Enterprise at Kellogg. And we tried working and making sure that students who had a particular interest in the social side, or what I call social entrepreneurship side, they had a chance to hear from different leaders and how these students can then make an impact of lasting significance. excellence. So if you look at the world today, I see that if you look at the last 500 years, the first phase of the world, I would say until the 19th century, the business model used to be what I would describe a model of colonialism. But by colonialism, I mean that at that time, the players were countries, and the countries went and acquired other countries. And the real metric at that time was what I would call power. Because at that time, the countries dominated, and we Indians were ruled by the British for almost 200 years. The next phase moved from colonialism to capitalism. And in the capitalism part, the players were no longer countries, but it were companies, and the companies started using a new metric called profits rather than power. And I am on the board of a company called John Deere and Company in America, and we have been in business for 180 years. There are companies like DuPont who have been in the business for the last 200 years. So from colonialism to capitalism, and if you look today, at the beginning of this century, the new model is what I describe entrepreneurialism. And by entrepreneurialism, I mean people who are willing to take new initiatives, people who are thinking differently, and these are citizens. So no longer countries, but citizens who think beyond business, and they are driven by purpose. So we have moved from profits, from power to profits to purpose. And today the players are citizens, and I am very hopeful that the best of this world is ahead of us. So in my MBA opening week, today is the Social Impact Week, I always tell people, by joining a business school, you start your journey from success to significance. But always first be successful. But while you are successful, you need to think about creating some social impact, giving back, doing something for your community, doing something for your society. Because if we as citizens, global citizens, if we don't do, who would do that for us? And that's why we need to think of a bigger purpose in life. I feel very privileged to be a part of CEIBS and Elena and others. When they thought of inviting me today to speak, I can just tell you that the best of this world is ahead of us. I'm very hopeful with the new generation. When I look at my 3 children, they have a purpose in life. It's not just to get the best job and make money. And hence, I again welcome you all. And I can just tell you that in this society, when Eleni was introducing me, I am a person of Indian origin, an American citizen, and was appointed as the European president for the top business school in China. Citizenship, your background does not matter. We are a global citizen. We are in a global society. We need to think of this world as a place where we have been given a chance to make a difference. And my father, who was blind, always used to say, Dipak, when you grow up, make sure that other person also gets opportunity to make a difference. So I welcome you all to this great conference, and I'm sure with all the panelists and the speakers that you will learn a lot. And again, as I always say, no challenge ahead of you is greater than the force behind you. CEIBS community is behind you. Dipak Jain is behind you. And whatever the best is in me, I offer it to all of you. Enjoy the conference. Thank you for including me.
Professor Dipak, thank you so much for such an inspiring talk. It's good to remind back of our purpose-driven role in the society. Thank you so much. Thank you so much. We are deeply appreciated. We now move on to our first event. So our first event is a panel discussion on ESG and green finance in China and Europe. We have been extremely honored to have eminent speakers with us. The panel will be moderated by Professor Zue. He's a professor of finance and accounting in CEIBS. He also holds the Parkland Chair. He's the director of CEIBS Center for Wealth Management, and he's also the co-director of CEIBS Center for Family Heritage. Please feel free to put your questions on the chat box and also on the WeChat live stream.
Thanks. The organizers, I feel glad that I have the opportunity to participate in the CEIBS MBA Social Impact Week. Actually, I start to teach corporate social responsibility as the first class for EMBA programs from 2015. At that time, I was surprised by the CEIBS innovation to ask a greedy finance professor to teach corporate social responsibilities. The course turns out to be well received by the students. Over the years, I was invited to teach CSR as the first class for FMBA, MBA in Finance, and the Gamba, and EMBA in Hospitality, Hamba, and the DBAs. In the meantime, I have developed more than 20 cases on the ESG-related issues. Starting from 5 years ago, my research team issued white papers on ESG for the listed firm in Asia market. Recently, I was involved in the open programs on green economics and green finance. I feel honored to serve as a moderator for the panel discussion on ESG and green finance in China and Europe this evening. I'm currently living in Shanghai. My compound I stayed at has been locked down for 40 days. You can tell that from the length of my hair. The COVID-19 pandemic has led to a deep understanding of the ties that bind us together on a global scale, as Professor Dipak just mentioned. There's a growing evidence that many of the same human activities that are contributing to the climate change are also contributing not only to the emergency of the new disease, but also to their spread. Environmental degradations, climate change pose a serious physical and transitional risk to financial stability, such as business disruptions, asset destructions, low value of assets, and increase in insurance cost. Whether to identify opportunities, mitigate the risk, and align value, investors are recognizing that the potential of sustainable finance by launching a new financial products or restructuring old financial products. There are numerous academic studies show that the ESG consideration actually have materials to both risk and return for today's investors. I'm glad that we have 4 excellent panelists join the event this evening. They have diverse industry backgrounds. They will share their insights on ESG and green finance in Europe and China. So today's panel discussion has divided into 2 parts. The first part of the panel discussion is that each panelist will present his or her initial statement. I will introduce each panelist right before his or her sharings. Our first panelist is Ms. Crystal Geng. Crystal is currently the head of China ESG Solutions for S&P Global. Before joining S&P Global, She was the head of ESG of Ping An Insurance Group and a senior sustainability consultant of Ernst & Young, focusing on the formulation of sustainable development strategy, ESG investment framework, and climate risk management with a strong focus on financial sector and the real estate sectors. In addition, Grace has participated in the development of many domestic and overseas industry standards and white papers, such as 2021 edition of Environmental Information Disclosure Standards for Financial Industries in China by the People's Bank of China. So today, Crystal will share his view on the urgencies of climate change risk management. Her presentation will lay down the foundation for the other three panelists. Crystal, please.
Thank you. Thanks so much, Professor Ray. And yeah, as Professor Ray has made an introduction, I'm Crystal Geng from S&P Global Sustainable One. If I may use 1 or 2 minutes to introduce the S&P Global regarding Sustainable One. Actually, the Sustainable One was just founded last year. That means to integrate all the sustainability related data and also the analytic tools in S&P Global, including our ESG scores, true cost and environmental data, the ESG credit rating, ESG indexes, and also the IHS advisory. Today is really a great honor to join the panel during our Sustainability Week. Again, actually, I attended this Social Impact Week last year. So it's my second time already. So I'm really pleased to see all of you again online. Okay, back to the kind of topic Professor has given me. And as we already learned that, I mean, in all the issues on ESG or sustainability, climate change is definitely the one with all the attentions from different sides of work. I'm not going to emphasize on the terrible results of the nature disasters causes, as we have already learned a lot from the kind of heroes movie series. Today, I'm going to share 3 aspects to show its urgency of climate change risk. That will be the international agreement. That is the first one. Second one will be the regulations. The last one will be the market, which is somehow quite like when we are doing the financial analysis. So the first one is regarding the international agreement, or we can see international collaboration. I think most of the attendants of the students, we all know Paris Agreement a lot, and also the carbon neutral timeline, the different timeline for different jurisdictions. Here I want to highlight one more thing is NGFS. It stands for Network for Greening the Financial System. The first reason is because it is adopted by more than 110 central banks and also the monetary supervisors from most of the biggest economic bodies worldwide, such as including PBOC and also Hong Kong Monetary Authority, Singapore Monetary Authority, and also the Central Bank of Canada, England, Japan, and also Korea, etc. So apart from its official, kind of official background, which you could be we should be aware of. It is also a more systematic climate scenarios with the social economic assumptions. It covers a very broad range of physical and also transition risk. Basically, it provides us 6 different predictions on what will be going on in the future and the different levels of policy strength and also the technology development. So I do suggest to pay attention on this international collaboration. Other than that, we have a lot. I think other speakers will mention it later on, such as the new SASB founded by IFRS. The second one I want to highlight is on the regulatory landscape. We all know the EU released its green taxonomy the year before last year, or I cannot remember. And China, we also have our new green catalog for green finance. And last year, EU has another one, which is called SFDR. And Hong Kong has a similar one from Hong Kong SFC. The SFDR and also Hong Kong SFC new requirement is to require the financial players, such as the fund managers, to watch out their climate risk and to disclose how climate risk is incorporated into their, let's say, organizational structure, their investment mandates, and also their portfolio construction and their product development. Moreover, I think the similar things are happening actually in UK, Canada, and also SEC from the States, as we all know. So we are under the more stringent pressures from all the regulators. The last one I want to highlight is market. Even though we heard that climate change seems to be more like risks, but actually for individuals and also for the corporates, for sure, we can see a lot of the potentials and opportunities as well in the great the very worldwide green economy or the transition economy we can see. I believe everyone knows the recent year's superstar industry is about carbon and renewable energy, no matter it's for the primary or the secondary financial markets. And also there is some prediction about the green economy in China market. The scale could be above 20 trillion USD dollars. The prediction is made by CICC and also Goldman. I mean, the number are quite similar. There's another one from China Green Finance Committee. The number could be 75 trillion US dollars. On top of this, we will have some kind of carbon tax in the future as well. No matter it's the domestic carbon tax or some cross-border tax. So definitely, climate change will cast the very wide impact for both the corporate and also for individual eventually, because the whole economy is going to transform into green. So that is my kind of assignment and the professor's task. So yeah, it should draw everyone's attention and act right now.
Okay, thanks, Crystal. Thanks for highlight the three aspects of the urgencies on climate change risk. They are the international agreement, regulations, and market force. Our second panelist is Ms. Grace Guan. She is the Deputy General Manager of the Syntao Green Finance, a leading China-focused ESG service provider, equipping the policymakers and the business leaders with the ESG data and analytical to advance sustainability agendas. With more than 10 years financial industry experience, serving at Deutsche Bank, Zhongde Securities, and PE firms, Grace devotes herself to the research and development of sustainable finance. She also worked as the Secretary General of China Social Investment Forum, China SIF, which is the delegated to promote responsible investment and to provide internationalized platform for exchanging and sharing ideas on issues concerning sustainable development. The 2030 carbon peak and the 2060 carbon neutrality target in China has driven the overall green transition of China's economic and social development. So Grace will share his view on China's solutions on the climate change risk. Grace, please.
Thank you for the introduction of Professor Ray. And this is my first time joining this Impact Week. Thank you very much for the invitation. First of all, I would like to wish Professor Ray and others who are currently living in Shanghai, wish them safe and healthy these days.
Thank you.
Also, good morning to those speakers and participants who may join us in Europe. Yeah, I'm Grace. I work for the Chinese ESG service provider, Syntao Green Finance. And before joining Syntao, I worked as a banker in several financial institutions. So when I first, a few years ago, when I sent some message on green finance on ESG to the WeChat group of some ex-colleagues, they will ask me, they will feel very weird. and will ask me that what type of finance it is, what green finance is. So, but nowadays they will reach out to me to ask about the policy dynamics. What are those financial institutions, what actions they are taking, and they're eagerly to be on top of it. So as a market practitioner in this industry, I personally feel that the ESG is shifting to mainstream in the financial sector for the time being. Certainly, climate is the #1 issue, as Crystal just mentioned. But first, I would like to share some of our observations of the development stages in China, as I promised. I think the first stage is before 2012, where the focus is more on economic end, its growth, its GDP. Although, I mean, the fast growth rate caused the pollution, the environmental problems. Also, people actually know that about the disparity in wealth distribution, all sorts of things, but people are still focusing on GDP. And in 2012, the green credit guidelines was first issued. It means that in the banking system, in commercial banks, the capital encouraged to flow to those sectors that could solve the pollution problem. That's the first action taken in the financial sector, I mean, to address these environmental problems. And the second stage, and also the milestone happens in 2016, meaning the 6 ministries issued the guidelines for establishing the green financial system. It means that it's not only within the commercial bank system, this framework, all the capitals, especially social capitals, are encouraged to invest in green sectors, and the financial products are not only green loan, green lending. It's extended to insurance products, to mutual fund product, to PE fund, etc., etc. So that's also another milestone. And the investment or the capital flow to addressing environmental problems are led by so-called green finance in China. And I think the third stage is now, or strictly speaking, it started from the declaration of 30/60 carbon targets by Chinese government in September 2020. So since then, actually, the capital flow, the ESG investment, all the green development is actually directed to how we can really get to that carbon targets 30/60. So we can actually foresee how the investment, the products, the market will, the policies will all be formulated around this target. So this is the third stage. Going forward, personally, I would believe in China, as we are still combating COVID-19, this so this is a public health issue. This and also biodiversity, like COP15 held in Yunnan, etc. So going forward, I would foresee that this ESG investing, this green finance, whatever you call it, will have a more diversified themes, not only for climate change, if we have that on track. So that's basically, I think, about China. And as we know that it's more, the driving forces is more top-down market, policy-driven market. But in addition to that, what are the market practitioners are doing? We actually did an assessment last year about the responsible investment practices of financial institutions in China. A mutual fund seems to lead this momentum, and second, by securities firm, the insurance asset management firms actually a bit slower, but they're catching up. So we can see that CBIRC announced last year that they are formulating a ESG investing guidelines for that sector specifically. So yeah, I think I would just stop here. Yeah, for this
Grace.
final briefing.
Thanks, Grace, for sharing with us the 3 stages of green finance development in China. The Green Credit Guideline was issued in 2012, and the green finance system was established in 2016, and the 30-60 carbon target set up in 2020. Okay, thanks, Grace, again. Our third panelist is Mr. Adonai Herrera-Martinez. Hopefully I pronounced your name correctly.
Perfect. Perfect.
Adonai is the Director of Environment and Sustainability at the European Bank for Reconstruction and Development, EBRD, providing the leadership and creating a strategy for management of the Eastern Europe Energy Efficiency and Environment Partnership, EU Neighborhood and Enlargement, and the Northern Dimension Environment Partnership Funds. Between 17 and 19, Adonai was the EBRD's President Advisor, supporting Sir Suma in his role as the Chief of Staff of the bank, including his interactions with the governors, directors, staff, and other stakeholders, providing advice on policy and operational matters. As the impact of climate change become more and more apparent, adaptation is emerging as an important aspect of the climate change agenda. Adaptation seeks to adjust the nature and the human environment to the likely disruptions and damage that will result from the effects of climate change, and focus on measures that will increase the resilience of the vulnerable sectors, such as agriculture, water supply, and infrastructure. EBRD launched its green economic transition approach in 2015 and pledged to raise the proportion of green investment from an average of 24% to 40%, the target which met in 2019. So Adonai will share us the European solutions on the climate change risk management, especially from the EBRD's initiatives. Adonai, please.
Thank you, Professor Rui, and thank you for the excellent introduction. And I'd like to thank the organizers for the kind invitation, and especially to yourself, Professor Rui, and Eleni Petri, my former colleague, for inviting me here today. And it's always a pleasure to be invited in one of the top global business schools to speak about our work. I wish I would have been able to be there in person. I'm craving to visit Shanghai, where I have very good friends, but hopefully next time. And I'd like to start the intervention by saying that in my previous life, I used to be a nuclear physicist, actually. But speaking today and speaking about ESG matters is certainly more complex nowadays than thinking of nucleons and quarks. So in any case, I'll try my best to make a little bit of sense of all these issues, and hopefully provide some clarity to the audience. I'll start with the context on ourselves and on NDBs in general. Multilateral development banks are financial institutions that are rather unique. And again, I'm giving you context for the audience to understand where we are coming from when we speak about environmental, social, and governance issues, which have many angles and many dimensions. So multilateral development banks are rather unique financial institutions. We mostly do project finance. We have governments as shareholders. So basically, we're not commercially traded. We have governments as owners, and we interact with the governments where we operate. And more importantly, our objectives go beyond the bottom line profits. But that's something that is becoming more and more mainstream, even in commercial financial institutions, where shareholder value is being displaced by stakeholder value. And I remember from my MBA times where that was already a trend a long time ago. In particular, on the European Bank for Reconstruction and Development, we are a unique institution within the MPBs, the multilateral development banks. We were created in 1991 to become a transition bank for the former Soviet Union. In a way, we operate very similarly to the Asian Infrastructure Investment Bank that is based in Beijing nowadays. We invest about 10 billion euros a year in our countries of operations, which are 37 countries, and we have 73 shareholders. More importantly, in the agreement establishing the bank, EBRD committed to promote environment in the full range of its activities and promote environmental sound development. So ESG, environmental, social, and governance issues have been at the heart of our mandate from the very beginning, together with the pillars of bankability, transition impact, sustainability, and additionality. So ESG is very much in our DNA for the last 30 years. Nowadays, sustainable finance is at the forefront of the international agenda, both on adaptation and mitigation, and is core to the European Green Deal. And I'm proud to say that our institution and the department I work in, the Environment and Sustainability Department, is a multidisciplinary institution that focuses on environmental social risks, compliance, and identification of green opportunities. Going into the definition of ESG, Professor Jain clearly explained before, for corporates and banks, ESG is the consideration of environmental, social, and governance factors, both positive and negative, with potential and with actual impacts in the decision-making process for investment activities. So in that sense, we've divided into two our approach to ESG matters. One is precautionary, that is developing safeguards to avoid risks. And the other one is proactive, to actively seek opportunities. We've taken both, as I said. Safeguards, EBRD developed for a long time, it has developed its environmental social policy, which is based on a do no significant harm principle. This principle is rooted in the concept of the mitigation hierarchy. Whenever there's a risk, we try to avoid the risk. If not possible, we minimize the risk. If not possible, or to a certain extent, we minimize it. Then we restore the damaged environment or element, and we then offset any residual risk or damage. This applies to a broad environmental and social issues, both on climate change, on biodiversity, but also on labor, on land ownership, indigenous people, heritage, stakeholder engagement, so on both on the environment and the social aspects. And it's divided into 10 performance requirements, just like for the World Bank and the other MDBs, and they are very much related to the UN Sustainable Development Goals. So we undertake very detailed due diligence in all process to avoid risk, but as Jack Welch, the former CEO of GE, mentioned, if the rate of change outside exceeds the rate of change inside your organization, the end is near for your organization. So in this context, we need to constantly evolve and move forward, following best practice outside in our due diligence approach. Notably the use of remote techniques during the pandemic and the upgrade with new technologies for our due diligence. This requires a lot of skills that we have in-house or we secure outside. And reporting and disclosure is one of those measures that are very much required from the outside world. We've signed up to the UNPRI, the Principles for Responsible Investment, but one of the disclosure requirements that we sign up to that is very relevant to the discussion today is the Task Force for the Climate-Related Financial Disclosure. I'm sure you were all aware of Mark Carney's speech back in 2015 when he clearly stated that the largest corporate risk nowadays is the climate-related risk, and put forward the tragedy of the horizon, whereby current generations, my generation, perhaps not the students, but my generation takes long-term decisions without bearing the consequences of those decisions, right? So TNFD has been created, basically crystallized thanks to that speech, and it actually focuses on shedding light on climate-related risks assumed by corporates, and the recommendations are broken down into 4 different elements: governance, strategy, risk management, and metrics and targets. But I think the previous speaker, Crystal, mentioned before that risks are divided into physical and transition risks, and they are also divided into acute and chronic risks, depending on the time scale. So TCFD is actually a task force to watch out for, because it is crystallizing as the gold standard for climate disclosure. And talking about standards, a point I would make is in terms of standards, there's a myriad of global standards that are being developed in order to identify what sustainable finance is nowadays. Possibly the most robust of those standards, the most comprehensive of those standards, is the EU Taxonomy for sustainable finance, which sets up a comprehensive compendium of economic activities that can be catalogued as sustainable, and a set of quantitative benchmarks that divide plain vanilla from sustainable activities. It's broken down into 6 environmental objectives: climate mitigation, climate adaptation, pollution prevention, biodiversity protection, circular economy, and sustainable marine resource management and protection. So basically, and the actions for economic activities to be catalogued as sustainable is broken down into 3 areas. One is provide a substantial contribution into one of those 6 environmental objectives, then do no significant harm in any of the other 5, and keep a minimum set of social safeguards. So all sustainable economic activities need to fulfill those 3 requirements: substantial contribution, do no significant harm, minimum social safeguards. We, as Bank, part of my team is working on the EU platform for sustainable finance and further developing the taxonomy, which is already 1,000 pages long, but it's worthwhile at least having a look at it. It's a formidable document. I mean, those are on, I mean, that blends both safeguards and opportunities. And I want to move on to opportunities. We were talking about safeguards before. It's important that we break down our activities in terms of achieving opportunities to actually move our economies towards a low carbon pathway. And we've divided as multilateral development banks the actions into 2 different areas. One is on the Paris alignment. That is the do no significant harm to climate, to make sure that whatever we finance does not undermine the mitigation and the adaptation objectives of the Paris Agreement. And the second one is substantial contribution to that, to those objectives, that is providing finance to truly green activities that will accelerate the decarbonization of our economies through green investments, from renewables to industrial processes to sustainable agriculture. Basically what the economic activities that have been summarized in the EU taxonomy. 3 other different elements. When the MDBs, when the multilateral development banks started discussing about climate action and the Paris alignment, we broke down actions into 6 different building blocks. 1 and 2 were adaptation and mitigation, Paris Agreement, alignment. The third one was substantial contribution to green finance. The 4th one was policy action. So basically, we need to make sure that we actually promote catalytic change through policy reform together with governments and corporates. That is from nationally determined contributions to national energy and climate plans in the EU to corporate decarbonization plans, because that is the way to actually achieve systemic change beyond the project by project financing, right? The 5th building block is reporting, and we discuss about reporting and TCFD. And the 6th building block is internal operations. We need to preach, walk the talk, basically, do what we preach, and make sure that we achieve net zero in our internal operations, from treasury operations to travel to, in general, scope 1 emissions, right? And I've talked about climate finance, but I think an element and a theme that is gaining interest and momentum is nature finance, right? And I was recently a few months ago invited to also speak at another Chinese university, Tsinghua, on financing biodiversity. The global community is becoming more and more interested in nature positive activities and in achieving co-benefits between climate and nature, to avoid environmental degradation and the loss of the services that ecosystems provide to our economies, right? And a document is quite interesting, framing the work we do on nature, is the joint MDB statement on nature, people, and planet that we issued during the COP26 in Glasgow, right, to accelerate nature positive activities in our investments. That document is very brief, it's worthwhile reading. It divides action into 5 areas. Leadership on safeguards, that is what I mentioned before, make sure that our precautionary principles are robust and are at the forefront of protection for nature. Make sure we invest more in nature positive activities, both directly investing in parks, but also making sure that our gray infrastructure becomes nature positive by the compensation, the extra net gains on offsets. Also work on natural capital valuation and the TNFD, the Task Force for Nature-Related Financial Disclosures, which is the equivalent for nature of the TCFD. The achievement of synergies and the improvement of reporting. Again, reporting is a key area. And if we're talking about synergies between partners and countries, that's an essential element. And I would like to quote yesterday, incidentally, I was at the City Week conference and on green finance, and His Excellency Geng, the Chinese ambassador to the UK, made this same point, that synergies and common cooperation, international cooperation, is key to actually address these market failures. Climate change and environmental degradation as a whole are global market failures that require collective action and coordinated actions to be addressed. So solution requires that coordination between governments to develop national strategies, industry providing technical solutions and corporate plans, financial institutions like ourselves directing financial flows towards solutions and away from projects that undermine our objectives, and obviously civil society driving the consumer choice and the civil action. As I said before, one of those synergies is the development of the TNFD, the Task Force for Nature-Related Financial Disclosure, that leverages on the TCFD, on the climate-related disclosures and recommendations. And the idea is to contribute to the development of robust methodologies for nature-related financial risk assessment, taking into consideration that nature risks are quite localized, quite different to climate, that are global, so quite localized, and there's like huge importance of supply chains for the mitigation of the nature-related risk. And think about the agricultural supply chains, for example, where we're talking about palm oil use or the use of natural resource mining in different countries, right? So this work will be essential. This work of the biodiversity COP15 that will take place this year in Kunming in China, actually. So I hope to be able to travel when the COP happens, hopefully in September. And to wrap this all up, because I know time is of essence and I've been speaking for quite a while now. To conclude, multilateral development banks can be catalysts in providing sustainable finance for promoting ESG through a unique combination of policy dialogue, blended finance, and the private sector focus. More importantly, MDBs support regulatory reform in governments and in private companies to make shift towards sustainable projects and demonstrate how this approach perfectly makes sense to business. And the ultimate goal of all our work is to achieve positive systemic change in the economies where we operate. And with this, I leave it there.
Okay, thanks, Adonai, for sharing with us the EBRD's experience in implementing the ESG strategies. So the ESG can be used as defense mechanisms to safeguard the risk. On the other hand, it can be used offensive mechanism to seek new opportunities. Okay, so thanks for sharing with us. Last but not least, the panelist is Professor Michael Sum. Michael is the technology venture builder and investor, have founded various companies over the years in diverse high-tech industries, spanning from across the fintech, AI, blockchain, semiconductor, and the new material industries. Michael is the chairman of the CarbonBlue Innovation and cross-border fintech venture building platform that is focused on rapidly commercializing, scaling blockchain and digital finance innovation to developing countries. He is also a chairman and a CEO of Freefold Finance, a cross-border payments company focused on the regulated digital currency interoperability and foreign exchange infrastructure solutions for financial institutions. Michael is the founding co-director of Fudan Fanhai FinTech Research Center at Fanhai International School of Finance at Fudan Universities. As we know, the climate solution innovation can both improve the existing models and the market and creating brand new ones. They can scale up existing technology solution and support the development of more disrupted ones. And while the breakthroughs in technology are critical to generate new opportunities, both in terms of value creation and climate impact. However, not all the company need to play in the breakthrough tech fields. There remains huge potential in deploying and scaling up existing technology through the business model innovation, especially digitalizations. So Michael will share his view on how technology can solve the issues on the climate change risk. Michael, please.
Thank you very much, Oliver. So today I'm going to talk a little bit about how digital finance techniques can be brought to bear into the sustainability and climate action. Right? Xi Jinping, has this carbon neutrality goal for 2060. Crystal has mentioned that's going to take something on the order of $75 trillion over the next 30 years or so to be able to make that target. Okay, China doesn't actually have all that money themselves. Okay, that's a big sum. In order to reach that carbon neutrality goal, China has to develop further in the next generation of its development. Going from a industrialized state to a technology state to develop its financial ecosystem. So there's going to be a major financial ecosystem opening up that occurs and allow essentially foreign investment to come into the market to invest that. Right. So I've been looking at a lot of things related to digital finance to enable things like green bonds. Right, green bonds is almost a $500 billion market these days, growing quite strongly. And there's literally trillions of dollars locked up by financial institutions that want to go into sustainability. In 2019, there was a pact of 130 of the top financial institutions representing 1/3 of global wealth, with over $47 trillion worth of combined assets that want to go into sustainability. Well, why? What's the problem? The problem is when you're talking about green bonds, that's like a typical bond, right? A corporate bond or a sovereign bond. The difference is the word green, right? Green means that the use of funds need to go toward sustainable green things, and there's different climate bond initiative and other sort of standards for being able to do that. The issue is there's a concept called greenwashing, right? Which is to say that you raise a $1 billion bond and then you use it to invest in a bunch of non-sustainable things. You have to have a way to track and trace the use of funds to make sure that it is green, and that tracking and tracing is a huge compliance standard for the funds to be able to invest into a project. So without the end-to-end tracking and tracing, you cannot unlock these funds. Okay, what is the technology that can be brought to bear to solve that problem? That's blockchain. Right, you can think of blockchain as next generation internet technology that allows the trusted sharing of data, right? And things that are locked on blockchain, we won't get into the technical details, but you can trust and have a transparency of the data that exists. So actually blockchain as this next generation internet technology is the enabling technology to allow something like a green bond to find global buyers and to unlock money that would otherwise not be able to be unlocked by compliance reasons. So, I'm working on, infrastructure that will allow track and trace the use of funds, compliance standards across jurisdictions, right? You can imagine cross-jurisdictional rules are all different, and what's the KYC and compliance standards, all the ESG reporting, right? Which is now actually very ad hoc and manual and offline, right? If I want to go and tell if this project is green, I need to hire a third-party, ESG reporting company, spend $500,000. It's all paper manual stuff, spend months to do that. only big guys, JP Morgan can do that, but a smaller company cannot, right? So the promise of the integration on blockchain, to the digitization, the automation, okay, the big data analytics, all that combined through the digitization will really lower the bar to allow a much broader class of investor, a much lower bar for maybe even smaller companies, eventually even SME companies, to get access to green financing, et cetera. Right? So that's where the technology comes in. It turns out that China is really leading the way in terms of not just the blockchain infrastructure. Xi Jinping a few years ago got on stage and announced that they're going to develop their own digital currency called the ECNY, but also that blockchain was going to be a nationally prioritized technology. You can think of it as infrastructure of infrastructures to connect all the IT systems, automate the information gathering, and then you can do automation with AI, you can do big data analytics, and you can do things in a nice format in this sort of new digital world, right? So blockchain, is being massively deployed. So I think there's an opportunity to enable cross-border activity, right? If you actually have a digital green bond, okay, enabled by blockchain, you can now fractionate the ownership of the green bond. You can get access to new classes of investor, and you can get a much more global set of investors to invest in something. So you're basically your liquidity pool, okay, to invest into green bonds would be massively accelerated. And then also up until recently, there was a nice yield differential in between say Europe and the rest of the world. Most bond rate yields were 0 or negative. In China, you could actually derive almost a 3% yield differential, which was causing a lot of inflows going into the country. So I think because of all these sort of macro effects and where China is, I think China is going to take a lead in these things like digitizing green bonds and other sort of assets and things like that, right? So that's one thing. The other probably interesting case to look at is in the carbon credit market, right? The EU just passed a major carbon tax, right? So if you're an energy exporting country, let's say in the Middle East, you literally have a multi-billion-dollar tax liability now because of the carbon tax. Okay? They need to offset. They need to find carbon credits to offset those the tax. Where can you find billions of dollars of carbon credits? Well, the only place is China. China is the only place that has the scale and has the sort of systematic wherewithal to be able to do that, right? So I think we're on the brink of being positioned to create a massive cross-border opportunity, okay, for green bonds, but also carbon credits. Hong Kong is positioned very strongly. The Hong Kong Green Finance Association is very strongly positioning Hong Kong to be a nice place with the rule of law to allow cross-border transactions to occur, to modulate China, carbon credits on an international market for international investors. So I think there's a huge catalyst here. Okay, I mentioned China a lot because I think China unique in the world because of the fact that it has so many green resources. It has the need to be carbon neutral, which is going to take $75 trillion worth of investment. It has the carbon credits that of scale that the rest of the world needs to offset their energy production, et cetera, like that. And that bridge from China into China internationally, combined with the ability now to digitize, okay, to now take an asset and to package it into a fungible form using the new technologies that exist. And then maybe even to consider settlements of these digital assets using things like digital currencies, like the ECNY or eventually the digital euro or digital dollar. This is going to be very, very powerful, right? In general, the whole idea of digitization is only 20 years old, if you can believe it, right? 20 years ago, we didn't have internet, right? And or internet was just starting. And but you will notice that going from 0% of the global economy, now digital technologies and digital companies represent almost 40% of GDP in a place like China or the US. Okay, so and that's a unilateral trend. Okay, it's only going to get more and more digital, not less, right? You use email, you're not going to go back to the postal service. digitization directly affects costs, efficiencies, and instantaneous use, and all the sort of benefits that you see now with the internet, right? That's what's happening now with digital finance, okay? Instead of the first digital revolution, which is the digitization of information, okay, which led to all these new business models like e-commerce, et cetera, okay? The new trend now is the digitization of value, okay? Anything of value can now be digitized, whether that's a commodity like a carbon, like a carbon credit, right? Or bond, or a stock like a digital security, or anything else, right? I mean, now you see NFTs, that digitization of digital collectibles, digitization of intellectual property. This is the next vanguard. And I think the time in 2022 is upon us where there's now massive institutional adoption of that. 86% of central banks are now thinking about creating their own central banks digital currencies. The private sector is creating a whole Cambrian explosion of private sector digital currencies. And then you have cryptocurrencies and all sorts of other things like this. So I think the promise of this is that by digitization, the same way when you digitize information, you made it free, you made it very shareable, you made it fungible, we call it, tradable, exchangeable. With that, any and all asset classes around the world can now be financialized the same way that the stock market is financialized, right? Imagine in the future, your little wine community can digitize, the trade of wine, right? And you can start to trade wine the same way you have the stock market. And you can also zap it, the interest of your wine from point to point using digital wallets with instantaneously, zero cost, very fungible, and very, very efficient. Right? And then imagine you can use all the sorts of financialization techniques on top. You can create an index fund. You can create a portfolio analysis. You can go and create a future or other derivative, right? And it can be brought to bear and made to everybody, right? The whole thing about technology and specific digital technologies is the democratization of that technology, right? In the first internet revolution, if you wanted to broadcast yourself, your dad needed to own a TV station. Okay, but now anybody with a cell phone, Lao Baixing out in the villages in China can directly zibo, become a Mingxing, have fan bases of tens of millions of people. That's democratization technology. Now the next phase of development is the democratization of digital finance to provide massive financial inclusion around the world, to give the same Lao Baixing the ability to invest. You can imagine now Lao Baixing in the near future can take their 5 RMB and micro invest into a digital green bond or carbon credit issued by the government, or forget about China, issued in Brazil, somewhere across the world. That is the future that is enabled by digital finance. So I think this is very, very exciting, and there are a lot of implications for sustainability to make this something that we can work with. And just to maybe just be more provocative, if you give me one more minute. I'm a UN advisor to different governments on things like digital bonds and things like that. So my last gig was to help Bhutan to think about how they could create digital bonds for their country. Tiny little country, just came out of least development status. They can't get subsidies anymore from the World Bank anymore. So they need to create this bond. But their interest rates on the bonds was 8% because they don't have credit, right? But so I was proposing to digitize their bonds. But one other thing I was doing, they have Bhutan is all about happiness, right? They created this gross happiness index. So instead of measuring the country in terms of GDP, they measure it on 9 dimensions of happiness. It's a UN resolved standard for happiness, right? If you can measure happiness, you can actually create a commodity out of it. So I proposed the same way that you create a commodity out of carbon, okay, to incentivize people to, polluting is what we call a negative externality. Okay, it means that because you can pass the costs on to other people, you pollute because it saves you money, right? But if you're taxed because of it, because we can measure your pollution, then we create an incentive system called the cap and trade system, and create this concept called commodity of carbon, which is a carbon credit, that we can economically incentivize people toward lower pollution. right? And with these modern techniques, you can do that with anything. With the Bhutan government, I can create a commodity out of happiness. I can create an economic cap and trade system to incentivize people toward happiness or toward peace or for any other thing that you can measure. And that's basically the 17 SDG goals, right? So I think it'd be very interesting. You'll see it first with environmental carbon credits, but you can imagine creating the equivalent commodity for any type of asset, synthetic asset that can incentivize people to be more sustainable across all the SDG goals, not just in the environmental space. So that's a little provocative ending, to be able to tokenize happiness, to trade happiness, to incentivize people toward, water security or, education or women empowerment or any of these things. But I think that's the future of digital finance, and I hope you find it exciting too. Thank you.
Okay, thanks, Michael, for sharing your excitement of digital finance. Okay, so use the blockchain technology to digitalize the green bonds and also the carbon credit market. Thanks a lot, okay, for sharing with us. Now, since I only have 10 minutes left, okay, so let's move on to the second part. In the second part, I will ask each panelist one question, okay? So each panelist will have 2 minutes, okay? So since we have only 10 minutes left, okay? So the first question is for Christos. So how can financial industry manage climate change risk, okay? What are the actual and potential impacts of the climate risk and opportunities on the financial institutions' business strategy and the financial planning? Crystal, please.
Okay, thanks, Professor Ray. Since I only have 2 minutes, I'm going to still follow the kind of golden standard mentioned by Mr. Martinez, right? If I pronounce correctly, I'm going to use TCFD as a kind of framework to tell us how financial industry can manage their climate change risk. Even though we have different players such as banks, insurance, and also asset management, and very important player is fintech, like Michael just mentioned. But for all, we do suggest, not me and not S&P, the whole regulatory bodies, they suggest use DCFD. So they have 4 pillars actually. The first one is the financial institution need to look at their governance structure, whether the management level and also the board level is overseeing climate change risk. So that is the first one. It's easy. It sounds easy, but it should be the first step. It should be a top-down kind of process in an organization. The second pillar will be strategy. That is how your business is shaping under the different scenarios. We all know some business definitely will be largely affected, like fossil fuels, but other business will also be impacted through the value chain, such as if you are a bank, your clients will need different financing tools. Previously, they only need the traditional loans, but now they need green loan or even transitional loan. And also, if you look at the asset management industry, maybe your clients, no matter it's institutional clients or the personal clients, they need different investment products. That means you have to design your ESG fund. So your clients will change your business strategy, right? So you have to look at how your strategy is going to change. The third one is risk management, still regarding transitional risk and also physical risk. So all the kind of institutions, we need to do the stress testing. For industry, for financial industry, we suggest to run a scenario like carbon pricing scenario and also the physical risk analysis. The reason why I suggest this tool is because most of your peers is doing the same thing, and we have the existing tools and useful methodology you can use right now. So the thing is, after you run this kind of scenario, you can check your asset at risk under different, let's say, carbon price and also different natural disasters. The underlying methodology is really very complicated. I'm not going to share with all of you today, and you can come back to me after this session. Then after we do this, we have to rebalance your portfolio as a result of your risk management. The last one is target and metrics. it is related to above analysis, but in a more quantitative way. Let's do that. That means you have to figure out, let's say, the roadmap as a result. The carbon roadmap. It includes the calculation of your current carbon emission on your portfolio level, and also your current risk impact to translate it into the EBITDA or profit. That is something quantitative, right? And also to set your own targets, your KPI regarding carbon. Yeah, and also maybe the KPI is not regarding carbon, but it's related to your business strategy. Let's say I'm going to have an investment skill. What is the percentage of green investment, or even more specific into a certain industry? Okay, I think that is the 4 steps or 4 pillars. My suggestion to financial institutions from my previous experience, both as a service provider and also the insurance company.
Thanks, Crystal, for providing us the 4 pillars. Okay, now let me ask Grace questions. The skill of China's ESG and green finance market has grown rapidly last years. Okay, I look at some numbers. The green credit balance increased by more than RMB 2 trillion compared with the previous years, and the size of the ES mutual funds and the green bond market has been more than doubled. Okay, so can you share with us how to integrate the ESG into the financial market practice, such as investment decisions, financing decisions, or asset allocation decisions? Grace, please.
Thank you, Professor Ray. Actually, before I go into that question, I would like also to give a very brief introduction of Syntao Green Finance that I work for. Actually, we are the third party. Just Michael mentioned that we provide third party green bond verification services to those issuers, and the cost is not that high. Otherwise, we will make a lot of money. It's only 1/5 of what you mentioned, the number. And I'm more on the conservative side. Actually, I cannot imagine living in a world that happiness can be treatable, everything can be treatable. But I can share you with our vision, the vision of Syntao Green Finance, that we believe that in the future, ESG considerations and factors will be considered in every decision. And what financial decision, business decision, even your individual decision, your daily decisions. So this is our vision. And Syntao Green Finance started to provide ESG data and research services to actually European investors in 2009. And just as Professor Ray mentioned, that actually one of the challenges that financial institutions is facing, I mean, when they are trying to integrate ESG into their financial products, into their investment management process, into their risk management process, etc. Actually, one of the challenges is the data insufficiency, and this is what Syntao Green Finance is doing. Is as a service provider, we have 3 databases. One is the carbon data platform, and so from our point of view, that we can see 3 trends. I mean, in the ESG investing world, as I just mentioned, standards is one of the most key issues. Actually, as I don't remember who mentioned about the ISSB, and actually IFRS. As far as I know, that it takes IFRS 40 to 50 years to develop all the accounting standards for financial data. So I would reasonably believe, although with the fintech, the support fintech with all sorts of technology, it may take less time, but I think it's very possible that it will take maybe decades to develop the accounting principles and standards for non-financial data for this ESG. So before that comes into reality, then financial institutions may have to develop their own views over what are the material ESG issues in their specific investment targets, investment their target sectors, etc., etc. So capacity building for financial institutions in terms of ESG is, I think, a key thing. You can rely on third party or service provider like S&P, like Syntao Green Finance to help you. But at the end of the day, you have to depend on your own views to formulate your own product strategy, etc. So yeah, I think that's my observation regarding this question. And since this panel is about China and European, actually, as I just mentioned at the very beginning, that China is more policy driven, but actually market practitioners, market players are also moving very quickly. As CIC, the sovereign fund of China, they issued an ESG investing guideline last year, and also Social Security Fund Board, they also incorporate ESG criteria into their selection process of external managers. So this is very interactive. But for Europe, maybe it's more market driven, more bottom up, but given the externality nature of these environmental issues, climate change or biodiversity or the ESG material issues, so the policies, the unified policies or coordinated behaviors cannot be absent. So it's no matter it's top down or bottom up, I think it's the nature of ESG investing or in combating climate change. Yeah, this is what we foresee about the prospect dynamics of this ESG investing internationally, I mean, particularly in China and Europe. Thank you.
Thanks, Grace. Okay, we know attacking the climate risk will not come cheap. Okay, so somebody estimate it requires about $3 trillion US dollars of investment every year to 2050. To raise those huge amount of money, the governments and the corporations are increasingly turning to green bonds. Okay, so the next question is for Adonai. Can you share with us how can green bonds and the social bonds market grow so fast in Europe? Adonai, please.
Yes, thank you, Professor. Yeah, I would very, very quickly, because we don't have so much time. I'll say that this is a growing market globally, and not just green bonds, all sustainability related bonds, and I'll go into SLBs as well. It's growing extremely fast due to investor demand, because the principles investors follow lately are not simply based on financial returns, but if you want, on societal benefit returns as well. There's a lot of conscious investors, a lot of pension funds that are more interested in returns beyond the financial ones, right? So there's a lot of, if you want, market demand for green bonds, but also there is an understanding in the market that the returns achieved by many of those green investments are actually higher, and they mitigate risks like the carbon transition risk that I think one of the previous speakers referred to as well, right? So basically, there's a double effect there from the demand perspective, from the risk mitigation perspective. The underlying assets on which green bonds are structured are perceived as more safe in the long term than those that actually undermine the low carbon transition of economies, right? That actually have clear carbon transition risks, right? Or physical climate risk, if we're talking about the adaptation risks, right? And I'd like to highlight the fact that we shouldn't just speak about green bonds, right? There's an emerging trend of a complementary asset class, which are sustainability-linked bonds and loans, right? Whereby investors provide financial support for general purpose corporate uses, working capital, restructuring, etc. But actually, the issuing entity commits, thanks to that finance, commits to achieve ambitious climate and environmental objectives with that money in the future, basically. And the penalty is a step up in the bond pricing. Those instruments are very interesting because they actually provide a mechanism for corporates to finance themselves, not just for green projects, while committing to tangible and ambitious environmental objectives, right? Again, that's the reason why this green bond and sustainability market is growing so fast, right? Because there's a market, there is perception of risk mitigation, but also there's a myriad of emerging mechanisms and tools that allow that positive capital market allocation, I would say.
Thanks.
And actually, that links very well to the points that Michael made before.
Very good. Give us 3 reasons. Okay, the market demand and risk mitigations and thanks. Okay, so the last question I prepared for Michael is how digital finance open a new business model for green finance innovation. But actually, Michael touched on that in his presentation, his sharings. So I saw a question from the audience. I also found it interesting. So I would like to ask this question on behalf of the audience. The question is, blockchain is mentioned since we have 3 triangle dilemmas. Basically, it's hard to be decentralized, secure, and economically scalable at the same time now. Do you think, is it possible to really solve this? Is there any fundamental problem or issue from the Satoshi's math proofs back in 2008 when he released the Bitcoin white papers? Michael, which question would you like to answer? The technical questions or the business questions?
Yeah. So, it's like this, right? The Satoshi Nakamoto is the guy who came up with the Bitcoin protocol. And that was the first mention of this concept of blockchain in 2009, right? And since then, there was this sort of, massive movements for decentralization, right? Basically, the concept of decentralization is very trendy, and somehow magically, decentralization is equivalent to something that's good, right? So the world, for what we call Bitcoin maximalist, someone who really believes in this future of decentralization, the ultimate state is full decentralization, full deregulation, etc. And I would say that in many ways that notion is just as idealistic as, say, an ideology like communism and things like this. Meaning, in the ideal sense, it makes sense, right? It is logical, whatever. Okay, but in practice, okay, it's very hard to make that work properly in light of specifically human nature. Okay, because if you have a full decentralized, deregulated system, it's basically like Pirates Bay. You have a lot of people who are MLM scamming and doing stuff, and that for the most part is what the crypto world is about. So actually, the notion of I question the notion of whether or not full decentralization is the answer. Okay, I do of course believe in decentralization, meaning a fully centralized thing is not ideal either, right? Full decentralization, chaos is not interesting. Full centralization has its problems, as we can see, but the answer is somewhere in between, hybrid. Okay, enough decentralization so that you don't have the problems of monopoly and bad actors and things like that, but one that is tractable. And I think that's where most of these new blockchains, they're trying to achieve. Actually, if you look at blockchain itself, I will note that even though it's Bitcoin itself, while it's probably considered the most secure, decentralized, blockchain because there's so many people mining and doing all these kind of things. In actuality, there's like 2 or 3 of the top mining pools together can form an oligopoly and take over the network. Okay, that's not very decentralized. Okay, so the theory of decentralization is there, but again, in practice, it doesn't work very well in practice. So I think to answer that question, I think basically the next generation blockchains, we went from Bitcoin in the first generation. We're now in the 6th, 7th generation. I think it's getting to the point where it's decentralized enough to get the benefits of decentralization, but still maintain things like scalability, things like security to solve this trilemma that the person's asking about. We are now at the practical use case, right? It's like it's in the original internet. 20 years ago, if you remember baud rates, right, for the modems and stuff like that, it was going at like 16K, 32K, very, very poor. But, technology tends to double in performance, exponential technologies every 18 months, because of Moore's law, this kind of thing. And so with enough doublings, after 5, 6, 7, 8 years, eventually you can load a web page within 30 seconds and e-commerce applications become practical. Okay. Same thing with blockchain. The first generation stuff was very bad. Okay. Not scalable, whatever. But now we're in the 7th, 8th generation blockchains. The new blockchains perform just as well as, say, the Visa network. So now you can actually put 50,000 transactions per second, TPS we call it, to support global payment network or something like that. And so I think it's now just after a decade of development, getting to the point where we can see commercial scaled enterprise grade applications of blockchain. And again, I'll just finalize, point out that I believe that China is leading the world in all that. Okay, China's central government, Yao Chen, who invented the DCEP, right, the ECNY, he's now over at CSRC, the China Securities Reform Commission, putting all of the digital securities registration blockchain. So in the near future, every security will be registered on blockchain. Okay, the PBOC is doing it with trade finance. Okay, everywhere else in the world is still experiment. In China, there's going to be a national trade system put on blockchain that's already deploying billions of dollars of transactions on top of it. It's really leading the world in that. So I think you guys are actually at CEIBS. My final point for the students out there at CEIBS, right? You are really in a very unique position. Your whole school is the merging of, the European international scene with China. That is your heritage and your strength. Okay, so I would say that I would highly encourage you, at the epicenter of the financial ecosystem in China, where all of this is happening, where blockchain is going to be deployed, where digital finance is going to be fully commercialized, with digital securities like tokenized carbon credits and green bonds are going to become the mainstream. If you can modulate that interaction cross-border internationally, which is your strength, that's going to be very, very good for your careers. Right. Thank you.
Thanks, Michael, for giving such an encouraging remark to our students. So due to time constraint, I have to wrap up. Okay. So this evening, we know that the risk arising from the physical effects of the climate change, including potential effects on the people, community, nature, physical capital, economic activities, and implication for company, government, financial institution, and individuals. So the financial market need to be prepared for the potential significant societal disruption, as well as economic opportunities. So the ESG, sustainable finance, digital finance innovations can play a significant role in managing climate change risk we are all facing today. Thanks again for our 4 excellent panelists, Crystal, Grace, Adonai, and Michael, for providing their excellent observation, knowledge, experience, insight, and wisdom on ESG and green finance this evening. Thank you.